Gary, I've spent 3 years in the investment industry, and from all that I've heard, the days of cowboys are long gone. Surely we're all safe?
Oh my goodness, that is a very, very good question, Leo. Um, no, you're never safe. You're never safe. There's always some rogue looking to take your money away from you. Uh, and although the regulations today are much better, I mean, Jamie and I sometimes joke that the 80s was like the Wild West. And remember, we had no real regulation. It was self-regulation before the Financial Services Act was enacted in 88. But if anybody thinks they're safe, I suggest they watch Macbeth, because Macbeth thought he was invincible. And as Hecate said, security, or the belief in it, is mortal's greatest enemy. And if you approach the managing of your finances with that in mind, you've got a pretty good chance of making it through without a major hiccup.
Thanks, Gary. So, what are some key alarm bells when it comes to considering investment?
So one of the big things to remember when you're choosing an investment is, what are you being promised? Now, Mervyn King, in his book The End of Alchemy, slams those who think they can predict the future accurately. And believe me, however smart an economist or an analyst seems to be, if they tell you they can predict the future, they're lying. Nobody gets that right. And the history of financial services is littered with major accidents where people have lost tens of thousands, hundreds of £1,000,000 on deals that were supposedly going to be able to deliver a guaranteed high return for a long time. So watch out for the investment that says you can get an above average return for below average risk, because I will tell anybody watching this, there is no free lunch in this marketplace. If you want better returns, it will involve some risk, and then you've got to make sure that you're prepared to accept the risks, and they are suitable to you. So you've got to watch that.
What examples are there of these kind of low risk, high return investment vehicles that we see people falling victim to today?
So a couple that have happened, one late 80s, was a company called Barlow Clowes, which was based on the Rock of Gibraltar. It was supposedly a business providing deposit-like guarantees, but equity-like returns. Well, it turned out that the money was being borrowed, interest was being promised to the investors, and the managers of Barlow Clowes were investing it in businesses. And when the 87 stock market crash came along and all the prices declined, they were caught out, and investors lost an awful lot of money, millions and millions of pounds. And the sad thing is, it was a lot of people that were actually seeking safety. So be very, very careful. And another good message with that Barlow Clowes incident is that check out the regulatory status of the people you're dealing with. The FCA has got a very good website. If someone's regulated, they will be on that website. So go and check them out before you do business with them.
Is it always the intention of these investment organisations, these propositions, to drain the public's money, or do they feel that they're onto something that over time just doesn't work out?
I think what you find with a lot of these crooks is that they've got narcissistic tendencies. And the narcissist creates a world in which they are at the centre of it, and it's all going to be all right as long as you do what the narcissist says. And the conclusion I've come to is the reason people part with millions and millions of pounds on dodgy schemes is because the person offering them is believable. Now, I think it's really difficult to get into the minds of one of these people and say, did they intend to defraud from the outset, or did they sort of think it would be okay? I think the important thing is, from the investor's point of view, it doesn't matter what their intent is. Just look out for the irrational promises. And if you spot them, whether somebody is setting out to defraud or is going to defraud unintentionally, it really doesn't matter, because the effects on your capital are the same, whatever the motive for the crook in the first place.
So, through a generation of the investment industry, do you find that the tools and resources have improved? Are we better equipped now to identify suitable investment opportunities for clients? How do we ensure that we're best positioned to find what's most suitable for the risk appetites, and also to ensure that we're mitigating against any risk that there might be within our decisions?
Yeah. I think when you look at a question like that, you've got to flip back a long time to see how far the industry has come. So we now have better contract law to protect investors. We have a compensation scheme, bearing in mind it's got limits. I think the deposit scheme protection is £85,000 a person, but it exists. We've got a regulator to enforce the law. We've got better transparency. We've got a good financial press that generally does a good job, and the journalists are more experienced. So if you read the weekend's press, there's lots of examples of journalists doing a good job trying to uncover what perhaps is the less savoury side of the investment world. So it is a lot better to work within. I think the client, the investor, is better served now than they were 30 years ago, and certainly more than they were 300 years ago. So things get better, but they are incremental and slow. And just because they are better doesn't mean they're fail-safe. And that is what everybody's got to bear in mind. So if you want to be safe with a bank deposit and you've got uncertainties about the bank, don't put more than £85,000 with it. Spread it around. And that, I think, is a key message, that the best defence you could have had at any time in life, in any generation, is diversity. Because if you spread things around through a range of securities and different asset classes, then you are not wholly reliant on one of those performing, so that you can do the things you want to do in life with your capital.
Okay, so how do courtiers' funds diversify as a safety measure?
So if you look through the multi-asset funds, they've got a very, very wide range of holdings. Those holdings tend to be extraordinarily liquid, which is a key issue in the market at the moment. And anybody watching this, what I'd say to them is, we went through the 2008 crash. We never once had to gate withdrawals, and we never had to apply a dilution levy, which is the reduction in the unit price that you apply to somebody selling a unit because they're getting out on better terms than the remaining investors. So that dilution levy is designed to protect people. We never gated, we never applied the dilution levy, despite the worst global financial crisis in the last century. And the reason for that is because we maintain diversification, and there's lots of people that have invested in those multi-asset funds know we also try and maintain a level of protection to defend the investor from the downsides. Now, if you're an investor with courtiers and you're trying to take more risk and you've gone for a growth strategy in our growth fund, then you get less downside protection and the value of your assets will wobble more. But if you're more cautious and you're in the cautious fund, then you've got an even broader range of diversification. You've always got some protection in place. So that's how we run money, to ensure that the assets that have been trusted to us are extremely well diversified and on the whole liquid. It doesn't mean we can't invest in something that's illiquid, but it's a fraction of the millions that we run that will go into those types of investments. And even then, we are all over them on the research. So that's how we've done it.
What about the UCITS funds?
Slightly different principle applies in the UK Equity Income and the Global Equity Income Fund. Those are pure equity funds in a specific segment, so they've not got the same level of diversification and they're equally weighted. So generally, there's 30 stocks in each, equally weighted, normally around 1% in cash. They're about 3.33% of each stock in there, which means you don't get too overweight on a particular stock. You've got a broad diversification, but they're going to wobble more than the multi-asset funds. So you've got to have a little bit more risk appetite if you're going in for those Courtiers equity funds.
Gary Reynolds, thank you very much.